Hello, folks. Brandon Chapman with you today. It's another edition of the Theo Night video for Monday, April 25th, 2022. Boy, it was an interesting day. Rallying off our lows, finishing up on the session after a blistering last 2 days, blistering the bulls. All right, we're seeing downside action, nearly a 3% loss on Friday. We are snapping back a little bit here today, recovering off of those lows. Now, if we look at the leadership board today, technology led out, followed by communications, cyclicals, healthcare. This is the S&P right there. We got staples and financials. The worst performing sector today, energy and utilities and real estate. So kind of interesting. Certainly you expect to see when you have a snapback, the areas that perform the worst, generally speaking, recover the quickest. But when you look at where technology fell in the week with today's bounce back, wasn't exactly the worst performing sector when you look at the last week. Obviously, in the last 6 weeks, it's certainly been one of the worst performing sectors out there. And communications with the news of Twitter today, obviously, maybe getting a step closer to inking the deal or completing the deal with Elon Musk, apparently securing the financing. We'll see. But it is approaching that price somewhere around 54.20 or something like that, about where we kind of gapped up here. So, again, it's an interesting day. And again, is this the rally back? Are we going to head back to prior highs? Or are we just reigniting? Are we ready for another smack down? And I think this is where you got to look at kind of the perspective of the areas that might lead or lag. And also you got to look at the VIX and VIX-based indicators. So, for example, with today's rally, did the VIX put in a high? Certainly looks like it. We shot up to 32. We faded back here to 27. Have we reached prior high levels, right? So, for example, 28 frequently is the high. But oftentimes it also stretches to 35 or 38, for example. So with the hard thing with the VIX is understanding where these inflection points come. Sometimes the low's at 16. Sometimes it's at 15. Sometimes it's closer to 20. The highs sometimes around 24 or 28 or 30 or 34. So there's ways we can look at volatility that creates more of a range and set points. Now, one of the things you can look at is the VVIX. The VVIX above around 150 or above 150 is oftentimes pretty key as far as points of capitulation. Now, when I say capitulation, what I'm saying is that it's a point where sellers have sold and they're ready to start buying again, right? So have we cleared the deck of sellers? This would not suggest that we have. Getting north of 150 is a much more secure point to say, hey, I think we're at our lows here in the near term. And again, remember, these are near term, bouncing for a few days, right? Sometimes longer. If we look at what's called the term structure, we're looking at 3-month volatility, VIX 3M plus VIX. For this, we can just kind of take out the price here and minimize that. We're focused on the yellow line. So normally, again, a value above 1.2 is a bearish indication. We actually hit that on April 20th. Intraday, this yellow line was north of 1.2. I think we finished like 1.18 something, okay? And if we were to go back to the SPY, you'll kind of see where that was near highs. Today, we did come down as low as 1.02, and we came off our lows, and we actually went up today. So point being is that we did not exactly see the indication from the volatility markets. And what that means is if the 3-month VIX is below the VIX, that means we're south of 1. So if we're down in this area, that's a stronger indication of support. Because why? We're saying the market, the options market, saying they're expecting lower volatility in the future because the 3-month is lower than the 30-day VIX. Okay? Another way we can look at this too is we can go to the product depth and look at the VX here. Now, we got kind of a swampus view there, but let's just take this contract here at about 27.5 to about 28. We'll just kind of round it to about 28, all right? So we'll go back. So we'll take the first 2 contracts here and go back to the VIX. Where's the VIX right now? It's at 27. So while the VIX sold off today off of the rally, what ended up happening is the VIX dropped below the VIX futures. And so the VIX futures never went into backwardation. And again, we'll just assume this is somewhere here. It's priced more like this instead of like this. And so the point being is that the VIX, the volatility markets aren't exactly signaling that we're at a bottom yet. Now, it doesn't mean we can't rally for a couple of days, but if you're looking back at the S&P and saying, hey, this is February 24th. Today is not February 24th. Could it be, for example, January 24th? Not even there, right? Could it be something more akin to maybe a March 15th? And we did get a nice rally off of that low. Yes. But prior to March 15th, we also had what? February 24th. Okay. So another way to look at this too, from a capitulation standpoint, $DECN plus $ADVN. Now it's going to be skewed a bit because of today, but look at it. The value is 1.04. What does that mean? We had more declining than advancing issues today. So despite the fact we had a market rally, guess what? We saw more declining than advancing issues. But more importantly, what we got on Friday, we saw about 5.5 times more declining issues than advancing issues. Now, if we look at it intraday, and again, that's similar to what we saw back on January 18th, for example. It's higher than we saw on February 24th, which is somewhere in here. However, let's look at it on an intraday basis, 20-day, 1 hour. It's not going to incorporate February. But anyway, let's go to a 5-day, 5 minute. What you'll see is this spiked up here at about 6.5. What does this tell us? We did not exactly get to that significant threshold 9 to 10, a 90% day. We're seeing 90% of the stocks declining versus advancing. However, we did get this on the volume side. So we take D-vol plus U-vol. You'll notice we did, on Friday, hit a value of 10, and we've just been declining all throughout today. So let's circle back here and go back to the S&P, SPY, SPX, whatever you want to use here. We'll look at a daily chart. So what does all this tell us? Again, this day is not as significant as what we saw, for example, back on the 24th of February. Intraday, we had a 90% day on advanced decline, and in terms of up volume, down volume, or down volume, up volume, right? We saw 90% of declining issues on 90+% of the volume. Very significant right after the open. Today, we saw it just improve after an opening kind of gap lower, trading lower, and we rallied throughout the day. Again, we just didn't finish on an extraordinarily strong note, other than the fact we did close near the high of the session. So what this means is there's probably not as strong of a kind of a capitulation day as you would probably hope, but there's some silver lining to this. What this means is maybe I got some fibs drawn here. Let me just remove that drawing. And you'll notice this fib I have drawn over this decline right here, this advance rather. We could see ourselves snap back maybe towards 438. Maybe we just rally to 433. I think there's a decent chance we get a couple of days out of this, but it's only going to reset to the downside. Why? We're in a bear market, folks. Right? I mean, just look at the policy, look at the trend in terms of GDP. All this stuff is angling towards the fact we're in a bearish market climate or a bear market, which means that the rallies are going to be sold. But don't be surprised if we start to reverse from here. And looking at today's unusual option activity, it didn't really signal a tremendous amount of bullishness. You saw some bullish activity, for example, in gold and in oil, Alcoa. We'll look at that stuff. But the reality is there were some rather large bearish trades in some other parts of the market. For example, EFA. I'll look at the dollar in a second. EFA was down really nicely today. Now, this is a roll, and it's a vertical roll to boot. But what we had here is we had the 70.63 getting rolled down to 68.61. Now, there's some profit taking in this. But it's also just saying, look, we're leaving a decent chunk on the table right now, expecting to see more downside here. And potentially downside to 61, at least where they're buying a 68 here. So when you look at the charts, you think about 68, pretty reasonable chance, maybe not in the next week or the next couple of days, but over the next week or two, we have a decent shot of maybe retesting our prior lows at 66 in EFA. And what's going to be a driver here? Well, if we look at what's going on with the dollar, you can take UUP as a proxy, the dollar making a nice bounce today. If you look at gold got crushed today, back to prior support. We've tested once, twice, 3 times over the last couple of months. So this is reflective of a very, very strong dollar. In fact, if we look at the euro/US dollar specifically, nice breakout to a new fresh low. Again, if it's going down, it takes $1.07 to buy 1 euro, whereas the other day it was $1.08. So it takes fewer dollars to buy euros. Again, this is indicating the bearish breakout we're seeing in the euro today. GBP/USD. Again, huge breakout on Friday and then continuing down today. Again, angling to the downside with a descending triangle of lower highs equal lows breaking through, blowing through that target. The US dollar/JPY, some discussion. Did Kuroda, is the Bank of Japan talking with the Treasury and trying to coordinate activity to stem the tide of selling here, which is very inflationary potentially for Japan? And if you want to know the road that we're going down right now, it is the way of the Japanese. All of our policy moves have mirrored exactly what Japan has done since the 90s, in particular since 2000. And you look at this big breakout here the last 2 weeks, very, very significant. We haven't seen this since late 2014. I guess we kind of got it in November of 2016. We're not seeing the reversal of the carry trade. We're seeing maybe an acceleration of it, which is very disastrous right now for Japan, meaning what? Imports are going to cost a lot more to bring in, particularly from the U.S., but you're seeing money flowing out of yen into dollars. And again, that's not a bullish sign right now for Japan. Look at the Aussie/US dollar. What we're seeing here is that going back to the daily chart here, right? Aussie's been breaking down hard over the last couple of days. We broke this trend line here. I'm not sure what that is. Let's remove that drawing. But the idea is we're seeing a major correction. We'll probably retest our lows. And this is very reflective of China, for example, as well. It has a huge amount of influence in the Aussie and Australian economy. So if you look at FXI, for example, down today. You can look at KWeb. This is web services, Chinese stocks. It was up slightly today, but again, near lows. Probably expecting thif the dollar continues to strengthen, you expect to see these global or rather foreign stock ETFs or emerging markets, developed markets, whatever, probably going to test the lows, and that roll is kind of reflective of that. As we look at IWM, small caps today did okay. It was up 0.61%, almost in line with what we saw in the SPY. Didn't necessarily outperform. We're at the same level we tested several times over the course of the last few months. But we look at trade today. Again, a lot of rolling activity, so it's not just purely bearish per se. We're closing out some stuff there, right? We're closing out some stuff there. But it was this 181. It actually swelled to about 77,000 contracts at the 181 strike. So again, you're seeing the hedges still being put on, maybe rolled from some of these other strike prices. But again, a significant activity there, mostly long put activity at the 181. Again, still indicating, look, there's risk to the downside here. The risks have not gone away. And so again, it just points to the fact we might have a near-term bounce, but the bigger picture is very likely lower. As we look at some areas that have recently shown some strength, like an NCLH, for example, this did make a slight pullback over the last couple of days, failed at resistance around 23. But we saw today it's not a huge number of shares, contracts that traded earlier, but it may have swelled a little bit since I looked at it earlier today. But you notice here at the 20 and 1750, so it did pick up a little bit. 7,500 contracts, buying the 20, selling the 1750, 11 days out. 1750's back where? It's basically back at support again. So despite today's rally, we saw a decent sized trade placed earlier in the day, but still looking for downside towards 1750. Caesars. This was a little smaller trade earlier. Again, I didn't look at it like recently here, but right here at the 65 and 60, 2,000 contracts. Again, what are we looking at on Caesars? This one did not rally with a lot of the travel space. Companies like, for example, Marriott, right? Marriott made a huge rally here, maybe setting up for a little bounce. Caesars actually underperformed a bit. So again, shows some of the other diversification of this company and where there might be risks. Today it did rally. We have earnings coming up on the 3rd, and you're seeing a decent size trade for this company here. It costs probably about $1.20, 2,000 contracts, looking at downside. And if you look at the time and sales here, again, it didn't occur necessarily in one trade per se, but again, it was in there as a spread trade. So again, we're looking for downside activity, downside potential here in Caesars to about $60, maybe at least looking at 65 going in the money. Again, that's not a terrible setup here where you're buying 81% implied volatility and selling 89%. So the skew is in your favor. So you see kind of where it's not. I mean, some of the areas that have been a little bit hot of late, travel and that kind of leisure, that stuff, rolling over today. But when you look at today's change, you'll see technology and communications, cyclicals in the mix. One of the things I've been following here is high short interest stocks. So we'll just go greater than 5% of the float. And again, this is not a comprehensive list, but a stock that we've talked about before, ATR, finding support here, right? Had significant option activity back on the 4th. You got DNA, you got NNOX, another one back here we talked about, got a huge pop. We faded back. You're seeing people come in. Jumia today was rather significant. And Jumia did have some unusual option activity for this week on the 850 and then the 950. Again, significant upside call activity just for this week. But again, you can see where they're targeting. You're targeting companies that have higher short interest. And you start to look at a stock like, SPHB, which is a high beta ETF. Again, testing support again. A nice little kind of, piercing line type candle formation where we have the down move here, maybe piercing the 50 halfway point of the body from yesterday. So if we're going to get a move, these are stocks to potentially watch. High short interest names that are seeing some unusual option activity. I have a search constructed for our members. We do frequently here at TheoTrade. But what you can do is look at something like SPHB. And I'm going to bring up the ETF here. I don't want to survey, but if you look at where this is, so these are the highest beta parts of the market over the last year as of April 22nd. What you'll see is that information technology, consumer discretionary, these are the top two by a really wide margin, especially information technology. And so if we're going to get a bounce here, right, you'd imagine that these names should do relatively well in the near term. So if you wanted to, you could scroll down here, look at some of these top names: Tesla, Mosaic, Oxy, right? Apache. Kind of belies what we're seeing here. These are the top holdings, right? Twitter's in there, SolarEdge, Enphase, Monolithic Power, Devon Energy. But you will notice there are some energy names in there, and there was an energy name today, for example, in Energy Transfer Partners. So for those that are members, I was talking about UNG back here, looking for an opportunity on a pullback, or specifically on /NG, specifically looking at if we pull back towards this kind of 650 area. That's what happened today. We're seeing a rally in natural gas, and earlier today it didn't look as bullish as it is right now. But Energy Transfer Partners rallied off its lows, finished near the high of the session today. It does have earnings coming up on May 4th, but the activity in Energy Transfer Partners today was actually a 6 May expiration, 38,000 contracts traded at the $12 strike price, again indicating what? Some bullish expectations here. Now, when you go down to the time and sales, you'll see one of that was bought, 25,000 contracts in one print at 9 cents. So again, it's saying, hey, we're thinking this earnings could come out relatively positive, and they're trading at a $12 strike price, which is decently out of the money here and targeting the prior high. So we may see a near-term rally in ET back to prior highs, because when you look at companies that are producing, let's just look at oil here. When you look at the term structure of oil futures, it's actually gotten more bullish here since April 13th when it was here, or April 6th. This line has gotten steeper. So again, we're not solving the energy problem. Certainly the dollar strength will hold back some of these plays here, but we're not honestly looking for these to roll to new highs, maybe just snapping back to prior highs, such as ET. A couple other stocks out here today. So we talk about, gold, for example, and its weakness with a stronger dollar. Now, if we look at 10-year Treasury yields, they did fall here. Now, if Treasury yields continue to fall, certainly there's the effect that the dollar could strengthen, but falling Treasury yields in and of itself is relatively bullish for gold. Although today, the stronger dollar really wiped it out. So the question is, we've had a lot of dollar strength over the last few days. Does that start to come in? And does this allow gold to open up maybe to 180, maybe even back to 185? I'm not the most bullish on gold. Again, we're not short on gold. Demand for gold doesn't necessarily increase a lot because of because of shortages, right? There's not really a shortage. The supply and demand situation for gold is pretty stable. It benefits from a weaker dollar. So maybe there's a near-term possibility, but really what's at foot here is something bigger, okay? What if there's a Fed policy error and they don't get to 3% Fed funds rate? They have to go to the trough earlier than that. This is a problem. So when we look at something like GDX or gold stocks will benefit by higher prices, higher gold prices. They've certainly underperformed over the last several days or week here. In fact, we draw just a fib retracement off of this sell-off here. Where are we? Probably close to 50% retracement. It's where we stand right now. Now, what we saw today in GDX is a December expiration. So we got to get out here a little bit. This was one that was... sorry, let me find this here. Yeah, 16 December. So we go 16 December. Oh, I just got to keep scrolling here. I'm like 60 and 70. Right? Buying the 60, selling the 70 out here. So this is pretty crazy to think about. GDX at 60 or 70. Now realize you're probably going to have some near-term potential downside here. But if there's a Fed policy error and they have to re-engage and start to print money, boy, that might be a possibility here. Okay, so I thought this was really interesting. Bring up something like AUI, and that was not a small amount of contracts there or notional value. AUI, this is a June expiration, pretty much at the money at the $5 strike price at AUI. So again, mostly bought, again, anticipating a little bit that it's a little bit oversold here. Maybe we get kind of a reflex rally back towards 6 or 6.25 in AUI. Also Alcoa. Now Alcoa is much more cyclical. We have had a much, much bigger decline, and you see the gap. The earnings came out. We had a bad few days here. Maybe there's a shot of making it back if you kind of blend these two candles together, maybe getting back to the halfway point of this down move. You'll notice here we had a projection of 90 to 98. We tagged this 261 and began to break down here. But anyways, we look at this. We're probably about a 61% retracement at the moment. So let me just clear my drawing set, and we're going to draw it here. So we're standing at the 61. So could we catch a short little bit up here to 75, maybe even 80? Well, if you look at today's activity, this is for a January expiration. See here in the 75 strikes. We go out here to Jan 2023, 75 strike, mostly bought there at $11. So again, it's a lot of notional interest. Again, it's not short term, which isn't necessarily as positive here. But, the 75 strike, that seemed like a pretty reasonable area this could bounce off of. But again, the stuff that probably seems the most reasonable, looking at energy, for example, makes sense. Look at some bearish areas that probably should be bearish, makes sense. Now, Goodyear Tire, this one's kind of interesting because, look, input costs are going up, but there's also potential scarcity, which, if we look back last summer, was actually a positive for the company. When you look at all the potential issues of getting inventory out of China, again, could we be in a similar situation we saw last summer where it made this nice rally? This is one that I spotted with some unusual option activity and other things on Goodyear Tire here. We kind of rode this from to about 20, it ended going all the way to 24, which was the 423% projection I set back here. But we're looking at a symmetrical triangle formation right now. Okay, if we can break through this at $14.50, we might get a move upwards to about $17.50, $18. If we look at today's activity on GT, it's actually a couple of different trades for this week. So sometimes this gets faded, but at the 13.5 and 14. So those are a couple areas we might see. It's not super far to the money, but it is looking kind of a breakout here potentially. The possibility that we could maybe minimum retest 15, but possibly even get back towards $17 to $18 is a possibility here. So again, we're trying to look at areas to potentially be bullish on, right? Again, high short interest names, high beta names. You could combine those, look at unusual option activity as well. those might provide some opportunity to the upside. But here's the point, right? We're in a bearish market climate. So any rally will likely result in what? Continued selling. So remember, last Monday, we talked about the prospects here of a rally off here looking at the 50% retracement. We tagged it and then began to sell off last Thursday and then Friday today. So where are we going today? Maybe back to 437 in the near term. This gives you some areas to look at that could be bullish. But remember, this is a great time to reload, to take more downside opportunities. So I think we're ready for another smack, and maybe we might delay it for a day or two. I think we had a pretty good bearish day on Friday that may lead to a couple of days here, but beware, we're looking at more downside potential in the near term. Okay. All right, folks, that's the video. We'll catch you back next week. Thank you.